Okay, and I'll just let everyone in, okay?
Yeah.
Mate, we've got a good crowd.
Yeah, you can see the numbers ticking up. Apologies for being a touch late, everyone.
Okay, I think we've got a bunch of people that just joined us. Thank you for coming along this morning. This is a fascinating topic for anyone who's in construction accounting, like we are, in the building and construction business. We're going to be talking about WIP today. I might just quickly, just before we get going, I might just get everyone, if you could, we're going to use the chat function today. So it might just be interesting for everyone just to share just really quickly where you're joining us from today in the chat, just so that we can make sure that that chat functionality is working, but also just out of interest to see where everyone is joining us from today. So just drop that into the chat. I will enable that so that everyone can chat now. If you just want to have a go at that again, and let us know where you're joining us from. Actually, I will get the technology right. Everyone should be able to chat now. That should be working. There we go. Excellent. Brilliant. Great. All over the place by the look of it.
Yeah, wow, good spread.
Yep. Yeah, Western Australia, Central Coast, Warwick, Sydney, a bunch of people from Sydney, a bunch of people from Brisbane, Mackay, Port Melbourne. Yeah, another Sydney. Okay, great. Dan, if you just wanted to, if you could just flip to the next screen. Someone from Manila, Tanya. Actually, Tanya is one of our newest employees. Welcome, Tanya. Good that you're joining the call today. So let's just crack on. Thanks everyone for joining. So today it'll be myself. I'm Phil Brown. I'm the COO and one of the partners here at Xact. And then Dan Wilkinson is the head of our CFO advisory team, also one of our partners. He is the real talent today. He's going to be taking us through this work in progress tool that we've built out that hopefully you'll get a lot from. I'm going to go through a quick bit of background on Xact, just really briefly. We've got a bunch of our clients here today as well, so you should probably know this already, but I'll go through a little bit of background on who we are, a little bit on tax accounting versus commercial accounting, and then we're going to go into WIP itself. So why WIP is so important, what is it, and then what foundations you need to make sure you're going to be able to calculate WIP as easily as possible. Then Danny's going to walk through the actual tool itself and show you how to calculate WIP using a multi-project kind of frame. So that will be sort of the main crux of today's session. We're going to have some polls throughout, so be ready for those. It'd be interesting to get your thoughts on a few things as we go. And as I said at the top, if anyone who joined us just before, we're going to use the chat function today. We'll have some questions as we go, but if you have any questions, put it in the chat, and I'll see if I can jump in at the right point with Dan and see if we can answer those as we go. So just really quickly on us, our clients, we're specialists in building and construction. So our clients, therefore, are almost all in that space. Our clients usually as well are scaling up. So they're growing. They've got a fair bit of work coming in and they're trying to make sense of all of that. They have a growth mindset in terms of wanting to learn how to do business better, how to improve particularly the financial side of their business. They're also starting to recognise that, it's time for a specialist. So someone who actually really, understands the business model of building and construction and how it ticks. And they recognise that they probably need to start plugging in what we would call a finance running mate. So someone who can really help them, navigate their way through the financial side of what it takes to run a building business. So our services, just really briefly, we have a bookkeeping division. Bookkeeping has significantly changed over the years. It's as much about system integration these days and getting all your tech talking to each other as it is about the usual functions of APAR and payroll and those sorts of things. CFO advisory, where Dan lives. CFO advisory is all about profit improvement, financial visibility, trying to improve the commercial underpinnings of your business, ultimately, though, to turn more profit. And then our compliance team, once you're making a bunch of profit, our compliance team are all about the tax and structuring side of things, again, through the lens of building and construction, trying to make sure that you are saving as much of your profit as you can when it comes to the ATO and the tax side of your business, and also asset protection. We operate in a risky business. So making sure that your asset structure will protect you if things really went bad. So that's our services. Just quickly, in terms of just framing the content that we're going to be talking about today, I thought I'd do it this way. That we say there are accountants and there are accountants. I've got two accountants on the screen here today. They're both in their mid-30s. They're both, if you want to click through here, Dan, they're both university qualified, obviously. One is a CPA, one's a CA. They're both partners in a respected firm. They love numbers, eat them for breakfast. And they're obviously both good-looking roosters, but they have a very different purpose in life. One is on the right-hand side, Josh. He's all about helping our clients pay less tax and protect their assets, like what I was talking about before. Whereas Dan's purpose in life is all about the commercial side of accounting, which is about improving profit. Now, I would think a lot of people on the call today would have experience with a tax accountant, but maybe not as much experience with someone like Dan, who really understands the commercial side of the business and can help people on that journey. So what is commercial accounting? Just roll this all out, Dan. So we look at commercial accounting in three different frames. The first one is data foundations. So what is your tech stack? What sort of integrations do you need to make sure that your accounting plumbing is all working the way you want it to? And then we also look at the people and the process side of the business as well. So we've got really high quality, reliable data that we can trust coming into the business. The second stage is understanding. So what reporting do we need to look at? What trends are happening in the business? What patterns are we starting to pick up in terms of the way the business is tracking? How does that sit versus industry benchmarks? What does your margin look like compared to other businesses that are in the same space? And then also materiality. What are the major pieces of the puzzle that we should be looking at and understanding in your business? A lot of commercial accounting lives in those two frames. So having good systems and processes and having good reports and understanding those reports. The big lever, though, is this final frame, which is around solutions. And so now that we understand what's happening in the business, what do we need to do to fix it, to change it, to improve what the destination is for this particular business? And so it all comes down to really what are the solutions that we're going to roll out in a business to make sure that it's going to improve. So that's the sort of framing. So WIP is a really critical part of the puzzle when it comes to having a strong finance backbone in your business and construction business, building and construction business. I thought we might just quickly test our poll. So Dan, if you just want to go to the next slide, I'm going to test this poll here, which is all about your current approach to WIP. Just curious about this, and just to start getting the juices flowing. So if we could just go through this, who calculates WIP in your business? Do it myself. I've got an internal accountant. My bookkeeper does it. My tax accountant does it. I've got an outsourced CFO or similar, or nobody's doing it at all. That's the first one. And then the second one is, how often do you calculate WIP? Monthly, quarterly, annually, never. And then how accurate, if you are investing time and energy, or someone in your business is calculating it, how accurate is your WIP figure? We will be sending the results out of these polls at the end of today, so that we can all have a bit of a look at that. But very interestingly, yeah, a lot of people having a go at it themselves, which is great. So hopefully this tool, and you'll be able to rewatch this video afterwards. We'll be sending it around to everyone that registered. So you'll be able to watch the video, and you'll get a copy of the spreadsheet that Dan is going to be sending around as well afterwards. So those people who are doing it themselves, you'll be able to use this as a good tool. If you've got other people calculating WIP, show this video to them so that they can level up in terms of their understanding of how WIP works. Okay, thank you for that. We're going to move along now to Dan, who is going to take us through just a bit of background on WIP, what it is and why it's so important. So over to you, Dan.
All right, I'll tag in Phil. Thank you very much. And obviously welcome everyone that has jumped on the call today. Please push through questions as you have them. Let's definitely make the most of your time while we're here. So I want to just briefly talk about the importance of WIP. So WIP, I guess the theoretical standpoint is called the matching principle in accounting, which means that if you spend $1, we want to try and align $1 of income, profit, margin, whatever it is in the same period. So commonly, and again, we'll run through examples a little bit later, but if you're not doing WIP and you're in the building construction space, you probably find your P&Ls going up and down, up and down, up and down, which from an accrual accounting perspective, or whenever you sort of look at larger businesses and you look at their performance, their numbers are nice and steady, and I guess away we go. So large building construction businesses will take on work in progress and will normalize out and smooth out the numbers. So it isn't to game it to make it look better or worse. It's to go, well, how much money are we making? And if it's good or bad, or compare that against budget, well, we should be able to see how it's performing. And then a good P&L with accrual accounting in there is a really strong, I guess, financial scorecard for your business overall. So I just want to talk about positive and negative WIP because we can get these, I guess, misleading terms out in the field as well. So positive WIP means is that you have commonly spent more money in the contract than you've billed. So you'll be feeling a cash flow pinch. So you might have a job that's $1 million in cost, 1.2 in revenue, but you've spent a bucket load on deposits and all the rest of it, you've had no income in. That'll be positive WIP. Now, if you have negative WIP, and I'm seeing a lot of builders out there do this now, where they front load contracts and try and get away with a bit more cash up front, which is obviously good for accounts receivable and really good for cash if you can get the cash conversion cycle through quickly. But that's where you're carrying negative WIP. So you might have this nice high bank account balance where you've got all this income in, but you might not have spent much of the project, in which case be really careful with that, because if you use your bank account as the scoreboard for your business, it can be pretty misleading, because right at the end, when you send out your final bill and obviously have all your final claims in, you're going to get a big smack of cash at the end as well. So if you're calculating WIP correctly, it tells you how profitable you are. It also strengthens your balance sheet as well, but also it really sort of helps you understand how much of that cash in your bank account is not yours. And it's usually sort of the final big piece in your balance sheet to work out how you're actually performing overall. So just to wrap, positive WIP means that you have spent more than the income you've gotten in, and negative WIP means you've actually billed a lot more than the costs you have spent to date overall. So pushing on, and let's just do a bit of a visual example here. So in this example here, we have a project that's worth $500,000 in revenue. So this is excluding GST that goes to the government. So just nice and simple. So the project value is worth $500,000. Now, in the same breath, the cost to build this project is $400,000. So this will be slightly different for all of you. You might have prelims in there or some overhead recovery, whatever happens to be. But let's just say the direct cost for this build is $400,000. So one minus the other is $100,000 worth of profit. Now, that is how your estimate looks. So the estimate goes, well, we should be billing out $500,000, cost should be $400,000. Now, once the job gets out of the ground, and say we're closing out the month, because we're trying to work out how much profit we're making by month, which is best practice. So we have spent $100,000 against this project in our accounting system, build Xact, whatever happens to be today, or we're 25% of the way through the build. Now, in the same breath, let's just say we're trying to close out the current month, July, and we have invoiced out $100,000. So if you're running a P&L for this job, it's going to show that you're not making money. It was 100,000 in, 100,000 out. Well, zero, which doesn't make sense. What's actually carrying here is that if you are 25% of the way through the build, you're actually entitled to 25% of the income. And this is how you start to unlock visibility on the profit in your business as well. So what's happening here is that you're actually starting to generate positive, because even though you spend the same money as the income you've incurred, you're actually entitled to 25% of the revenue or 25% of the margin. So when you calculate this out, this year is positive WIP of $25,000. So when you look at the overall margin overall, it should be running about 20%. So you do a credit to income and then you generate an asset in the balance sheet. But what you want to see here is that you want to try align the costs, the revenue, but also the margin in your business as well. So in this example here, again, 500 versus 400 in costs and revenue as far as invoicing out is exactly the same, but you have actually understated your income when you're trying to understand the profit of your business by about 25,000. So why is WIP so important? Well, the fundamental of it is that if you're not doing accrual accounting or commercial accounting, I mean, your numbers are really lumpy. So you might have large claims, especially on the sprint to Christmas. You'll try and get as many claims out as you can. You know, just January is always a bloodbath, especially running up to Australia Day or any of those other sort of public holidays. Easter's always a nightmare. But you should be able to micro measure how much profit you are making month to month, and obviously by project too, because when you do post WIP, you do want to post it by project. So we definitely need it in to stop this lumpiness in the background. If you aren't using WIP in your business and profits bouncing around all over the place, you go, well, there's no way I've lost 30 cents on the dollar this month. I made a huge profit of 50% and bouncing around. I mean, building construction just doesn't operate that way. So what do? You go, well, what can I get my hands on? What can I touch? So you start using cash as your scoreboard. And obviously building construction is very lumpy, claims and invoices and accounts payable runs and super. I mean, if you're using cash as that measurement tool, it can be massively misleading. So as long as you keep profit under the microscope, cash as a byproduct generally works out. So focus on profit first. Profit is king, cash is as well. But if you're profitable, it opens up a lot more other options to get your hands on cash, especially with the banks, etc. And then WIP is really the bridge that brings the two together, because obviously one's cash, one's profit, and WIP tells you, well, it can assist in telling you how much that money is yours in the bank account, which is probably the burning question when you go to bed. Each day or each week we get a big run of claims in. I see all this cash, but how much that's mine? So WIP really, really helps that out for all. So why is it important? I mean, apart from knowing where your profit's up to, if you are trying to leverage either your personal balance sheet or the business's balance sheet and you're asking for overdrafts and extra money, or you're looking at developments, if you have profit bouncing around like a yo-yo, like I see in a lot of businesses before I bump into them, banks won't like it. Banks like predictability. It's boring. They want to see that you know your numbers. They want to see that you have your finger on the pulse in your business. So if you have WIP in there, it should be nice and steady as far as what you're reporting. And then banks will generally warm up so you go, hang on, this person knows how to run their business. They know exactly where they're heading and how profitable they are. Obviously, for the partners and shareholders as well, I mean, why be in business? I mean, we're not here as a not-for-profit. We want to make money. So there's no reason why you can't micromanage that each month, not try and average a period or do it back with the beer coaster calculation. Because if you get the WIP right, it's usually the final piece to unlock how profitable you are month to month. And the final piece, the obvious one, which a fair chunk you might know, is the regulator. So if you're not recognizing WIP, especially if you are carrying large negative WIP or large positive WIP, depending which way it goes, I mean, you could be missing out on a large asset on your balance sheet. So for example, if you're carrying large positive WIP, which means you've spent a lot, but you haven't had much income in there, your P&L is going to be showing a largish loss or obviously diminished profits. And then your balance sheet is going to be weaker because of that as well. Because you've spent the money, you are actually entitled to the revenue and the margin and the asset that sits in there as well. So that's obviously only going to make it better for QBCC purposes too, assuming you've got the calculation right. So this is actually from a deep dive that I did some time ago, and this is actually, well, previously an existing client. Well, they are an existing client, but converted from the deep dive to this. This is commonly what I see as far as what profit looks like without WIP. So this is all driven by claims. I mean, usually accounts payable and your creditor runs are pretty standard, but this here is just month by month by month, profit down the bottom, and then it bounces around like a yo-yo. So if you're sitting here in February going, oh, geez, how much money have I made? I need to average this, but I haven't pushed that claim out. And then you roll over to March and go, I got $1 million. the P&L is going to be through the roof. There's no way you've made 80% profit in a month. So you chop this out and chop that. What you need to do is roll out a good work in progress process, and it should look something like this. So there's a little bit of blue sky with this one, but as you can see, it's getting nice and predictable. And again, as long as you're profitable, you're generally going to be all right, minus any macro effects in the economy or anything like that. But micro measure profit and cash as a byproduct most of the time works out. So this is nicer, a bit easier to read. We know exactly what's going on. Now, if we have WIP in there and we have had a damaging month, at least we can act on it. We don't have to get to the end of the project and clench and hope that we have made some money right at the end either. So WIP is an interesting one. The calculation itself is actually pretty straightforward. There's heaps of calculators out there that'll tell you how to do it. But the good thing about WIP is that it actually instills a lot of good practices into the individual to get the WIP right. So, for example, you need really, really, really good bookkeeping and good data to make WIP work. Because if you can't measure the cost by a job or the revenue by a job, well, it's going to make WIP really, really hard and frustrating, to be honest, because WIP is the end product of all the good processes and effort upstream. So you need really, really, really good bookkeeping in place. So it isn't just, get the invoice in and pay quickly, but I want to track every dollar that goes into COGS or direct costs. That's everything above the gross profit line, and that's allocated to a job. And I want to micro measure that in the background as well against your original estimate. And that dovetails into job costing. So there's another slide on job costing coming, but I see all the time builders build out these beautiful quotes. They go on for lines and lines and lines and lines, and they really, really, really know their stuff. And as soon as the cash starts flying around all over the place, the job costing stops. So when they start getting large invoices in for the job, and I go, hey, how are you performing on this job halfway through? Commonly I get an answer going, I think it's all right, or I think it's okay, or, the big stuff's all right, but I'm not sure about the rest. If you have good job costing in place, so it's the invoice matching principle. So for example, if you have an estimate for bathroom 2 and the tiling is going to be 20 grand, and say the invoice comes in at 20 grand, well, me from my side, I couldn't care. Move on, you've hit budget. Whereas if it's come over and you get an invoice of 25, well, guess what? You've just cooked 5 grand in your profit. You have to be able to micro measure that against your quote in the background. That's job costing. And then we want to calculate it monthly. So doing it at the end of the year, 10 months after the fact, when you sort of go to do your tax return, that's really not good enough to unlock financial clarity in your business. Best practice is calculating it monthly. Monthly accounts, monthly end of month. Here's your financial pack. Here's your profit and loss balance sheet, cash flow, accurate accrual accounting in there. And you can actually see what's going on in the business. So this philosophy isn't rocket science. The theory is easy. Rolling it out practically is a bit harder, but every big business does this. And I think that's what a lot of people on this call need to do, or Daniel is going, well, I'm turning 5 to 10 mil. What does a $30 million business do that I'm not? Commonly, it's WIP and getting that calculation right. I just quickly want to touch on this because this is a fundamental piece of WIP, and it's also really good hygiene to micro measure your profit. So what we have here, and I'll sort of try and go through this at a reasonable pace, is job costing. So we have an invoice that comes in. We have 3, for example, you might have 3 jobs on the go, and we need to track this all the way down to the lowest common denominator. So item 1 in that tiling example before, the estimate might have been 22 grand. The actual cost that's come in is 27. One minus the other is, well, we've cooked 5 grand of our profit. So instead of making 20% on the job or 100 grand on the job, we've now torn up 5. And what we need to do is that everything that sits up in COGS or direct costs, they're interchangeable words in this industry, is I want to track each of them back against the original estimate. So whether it's Build Xact or Build a Trend Procore, JobMan, whatever it happens to be, I want to see that COGS entry against this. And this here really is your leaderboard to see whether you're winning or losing as far as your job by job profitability goes. And if you get this right, honestly, WIP just falls out at the bottom of this process. And Phil, I think you are back up.
Yeah, thanks, Dan. So we're just going to do a quick, thanks for that. That's sort of a bit of a scene setter there. We're just going to do, because job costing is, we think, a really fundamental part of the pie here. We thought it would be interesting to do a poll on job costing as well. So here it is. And these are the little tests that we have when we're working with clients initially, just to understand what they're currently doing. So do you match invoices to the specific job and compare to the estimate? I never do that. I sometimes do that. I always do that. And then the next part of this, if there is a variance to the estimate, do you update your actual profit position for the particular job? Unfortunately, we do see a fair bit of activity in this space where you really don't know whether you've made profit until the end of the job, which just really sets you up for a fail. If you know how you're traveling with your margins throughout the job, you give yourself the opportunity to claw back margin, at future stages and through variations and the like. So these are just two kind of real fundamentals around job costing. And it's just something that it's a binary. Unfortunately, the people who are doing this sometimes or never, you're either doing job costing or you're not. It's like you have to be doing it properly. Otherwise, you're going to have a misrepresentation of what's happening in the business. Okay, so thanks. We had 54 people answer that one, which is great. So I'll just quickly share those results. Looks like a lot of people are matching the invoice, which is great. But we don't really seem to have a system for then seeing whether we're traveling well on our profit for the job throughout the job. So that's something that's another part of the job costing pie. We're going to do a job costing webinar that's coming up in the next month or so. So if you want to learn all about that job costing process and getting good processes in play, please join us for that. I'll stop sharing that. And Dan, if you want to go get on with the show.
Yeah, thanks, Phil. I think we're actually up to the tool now.
Yep.
So let me just change gears and bring up the spreadsheet. So there are heaps of WIP tools out there. I mean, there's heaps of downloads. Some of them are calculated different ways. The method that we're going to do here today is the cost of completion method. So there's a couple of ways to calculate this. One is that the cost of completion method focuses on cost. So what are you spending? So if you have $1 million cost and you spent 500,000, well, guess what? You're 50% of the way through the build. That's the cost of completion. There's a couple of other tools out there as well, which might be the QA/QS method. So you might have a quantity surveyor that walks around on site and go, hey, windows are 44%, and that's 84 and 25 and all the rest of it. I mean, the big guys do a lot of that, and they'll actually accrue revenue and cost. So this WIP fundamental goes, well, what's the cost base, whatever it is, and then you do an accrual to revenue to line the revenue and costs up. The QA/QS method commonly does both. So if they're sort of 45% of the way through, there'll be a push to revenue and a push to cost. It's pretty complex. I mean, if you're sort of sub 30 mil, I mean, I think it's a bit of a rabbit hole. It's expensive, people running around on site, but as much as we'll be covering off the cost of completion method today. So this tool, along with this video, will be available at the end. We'll actually release on our website and I guess release it to everyone that has registered and attended this event. But please drop in questions as you go. Phil will jump in and give me a nudge if there's anything complex that comes up. But let me just run through this now. So this is the WIP tool. It will be a bit of a faff just to get it set up. But once you have set it up, it's almost like muscle memory and it's fairly straightforward to update. And again, we have a couple of assumptions in here that your data is not too bad, which makes updating this a bit easier. And it is recommended that you do try and do this each month overall. So what we have here is we have 3 examples. You might sort of tell those of you that use Build Xact, we just use Build Xact as the example data input into the sheet. So this side here is all inputted, and the sheet does give you a few prompts here as to what's inputted and what's calculations. So anything that is input is user entered, i.e. yourselves or your accountant or whoever. Calculation cells are obviously calculations, and it does give you a couple of examples as to how this is calculated up to the right-hand side. So list down all your active projects. So WIP only affects active projects. So if all your variations are in and all your costs are in and all the rest of it, well, guess what? It's not work in progress anymore, so drop it out. But only drop it out of this once you know all costs have been received and all revenue has been received overall. So if you have good job costing in place and hopefully a good purchase order system in place too, you should have your finger on the pulse around that. But if you need help with any of those items, definitely reach out, please. So itemize out the jobs that you have on the go. I always like to have sort of start date and sort of target completion dates in there as well, just so you know when jobs are coming off. And you can almost use this as like a bit of a micro forecast as to when you need your next job to start. And then as you come across to the right, this is broken up into 2 sections. So this section here is all from your quoting system. So whether it's spreadsheets or Solo Assist or Build Xact, whatever it is, this here is all the quote. And then as you come across to the right-hand side here, all this side here should ideally come out of your accounting system. And there's a few calculation methods in this as well. So I'll start with the left-hand side first. And I'll probably just use these two jobs here as an example, and then I'll talk about the impact over to the right-hand side. So in this section here, I want you to add in what is the contract value, including GST. Now, just a little proviso with this is that this works really, really, really well for fixed price contracts, but it can get a little bit wobbly with cost plus. So happy to take questions on that one at the end, but I'll just focus on, I guess, stage-based claims and contracts for this, for the purpose of this. So the contract value, including GST, is 550,000. Now, as you raise variations throughout the job, definitely drop these in too, because obviously varies come and go all the time. You know, sometimes they're monthly or weekly, depending on the client, but definitely drop them in. So this number here should be fairly fluid, depending on, I guess, on the type of business that you do run. And then it gives you the contract value in total, including GST. So that plus that equals 561. Now, as you come across to the right, and hopefully these are fairly self-explanatory, the updated contract price here rips out the GST, because obviously the GST is not yours, it's not profit, it goes straight to the government. GST credits collected and paid out. So this here pulls out the GST because that's your money essentially. There's no 10% marginal postage on that. The next section over here is what are your budgeted costs, excluding GST? So what's the cost to build the project? So depending on how you have quoted, because you want to try and line up the line items as best we can. So if you're the owner and you have your time in there for preliminaries or site visits or whatever it is, you want to make sure you do pick up all those in this entry here. So the budgeted cost is what is the cost to build? I don't want to see overhead recoveries in there. This is just stuff that sits around the direct cost. So overhead recoveries, rip those out. And then one minus the other is the profit. How much money you want to make from it. So this is GP before overheads. And then in this example here, it's a 20% margin. And then then I have listed these out line by line, 20%, 1933, and then we have these built in. So the value of the project's on the go, 1.5. The value of the profit here is 319 with an average margin of 21%. So enter these in sort of one by one. You can add in more rows here as well if you're a higher volume builder or do lots of renos or bathrooms, whatever it happens to be, but it's definitely worth the effort, this piece. Now, coming over to the side, this is where it starts to get a little bit tricky depending on the quality of the data. So theoretically, if you are entering invoices into Xero or MyOb, you're entering those invoices in. Ideally, you want to enter them through Build Xact, and then the system syncs it through to Xero so that you know the two line up. Ideally, you want to run a job-by-job profitability report or like a transaction report that shows the job number, and you can almost just write in whatever the costs to date are straight out of your accounting system. So usually one of the checks that I do, particularly with my clients, is I'll actually jump into their, before we do the monthly results, jump into their COGS or their direct costs and make sure that everything in there is allocated to a job. Because then that way I know that every dollar is tracked against a job. And I know populating this cell here will be super accurate as well. So in this instance here, we have spent $170,000 on this job as of the end of February, is how this side works. Now, these two grayed out columns here, this is all user entered based on the quality of the data that you have. So in this instance here, and there are some call outs and prompts here as well, but in this sort of first column here, this is for project expenses that haven't overrun, but are not actually allocated in your software. So you might run a job P&L for this one here out of Xero, but for whatever reason, 50 grand's been misallocated, or it's in an assigned column, or it's been spent somewhere, you just can't find it. You can actually manually adjust that up. So the actual costs on this job here are 220,000. So these two columns here are designed as a bit of a catch-all where you know the data's not great, but while you continue your journey on accurate data and accurate job costing, there is a bit of a workaround with this one. So say going backwards 4 or 5 months, you might have had a dry rate that's been that has gone over, or the slab pour has gone over, but you can't actually job cost it against this. You can manually enter it there. So just make sure you do write some notes in there as well so you remember what that is. If your job costing is good and your COGS are accurately allocated, well, don't worry about it. But this is a bit of a catch-all here as well. Now, the other piece in here too, which is probably adding a little bit more complexity, is if you know you have job overruns, and this bit's actually really important, is if you're overrunning on jobs, what will happen is that, say in that example before where we had $100,000 worth of costs against a $500,000 project, but let's say 25% of it's an overrun. So, 25 grand, we don't want to over recognize a profit just because we spent more. We don't want to recognize future profit in there because there is actually some bleed in there. So if you have overspent along the way, we want to try and isolate that out and drop that in here. So ideally, you should be able to get this from Build Xact. Builder Trend has some functionality in there as well around sort of forecast complete. But if you are overrunning on projects, make sure you do just drop that in as a separate number as well, because we want to actually flush out that loss and talk about it, not just accelerate all this profit and all this WIP and then get right to the end and go, oh, geez, we had this big loss at the end of it, or we chewed up a huge chunk of our profit here over to the left-hand side. So I'll probably talk about this one first. This will be a little bit easier to sort of wash through. So in this instance here, we have $789,000 in income, $35,000 in variations, $610,000 to build, and we're hoping to make $139,000 out of it. Now, come across to the right-hand side, it looks like job costing. This one's pretty accurate. So we've spent $23,000 to date. We come across to the right-hand side. This is actually 4% of the entire project. So when you look at this one here, we go, well, 23,000 divided by 610, and we're using the cost of completion method with this. We're saying that we're 4% of the way through the project. So that's the sum of deposits. You might have some provisional sums starting to come through as well, or preliminaries, whatever it happens to be, but we're 4% of the way through. Come across to the right-hand side, this is actually what you've invoiced to date. So over here are the costs to date, sitting down in COGS. So nothing to do with overheads or anything like that. Come across to this side here, this is what you've invoiced to date out of Xero, Maya, whatever it happens to be. So this one's really important as well, and we just want the cutoff as of whatever monthly period you're trying to do here. So February, June, whatever it happens to be. So in this instance here, the builder has pushed out $70,000 worth of income. So you can see pretty quickly here that if you go $70,000 divided by the contract value to date, price ex GST, they've actually invoiced out about 9% of the contract value, which is great. So this here means that they're carrying negative WIP. So either they're converting WIP to accounts receivable to cash quickly. So just be a bit careful, because if you're using a bank account as a scoreboard, that can be inflated quickly because the income, as far as the percentage goes, is actually quite a lot higher than the cost base goes. So the way this calculates is it goes, well, actually, you're only entitled to 4% of that income, and 4% of that income is $28,000. So there is a calculation method in place. So you've invoiced 70, you're actually entitled to 28, because 4% of income, 4% of cost, 4% is your margin. So $41,000 of that income isn't yours, or it's negative WIP in this instance. And just a reminder, a negative WIP, you build out more than the actual cost base in the background as well. So super important. The one down the bottom is actually the other way around. So similar sort of process, costs, revenue, estimates are out to the side. The software here is $130,000. So yeah, sorry, $130,000 in cost spent. Well, one divided by the other shows an 81% completion based on what's on the system. But then for whatever reason, we've only been able to bill out $90,000. So the bank could be bottlenecking us, or there could be some differences in the claim process, or the client's being a bit painful. And you're going, geez, I have no money at the moment, Dan, what's going on? Well, the answer is that you've spent a lot, invoiced out little. If you could actually invoice out dollar for dollar, so say you can invoice out 81,000 and then convert that to cash, you're actually behind the eight ball by $105,000. Because if you're 81% of the way through the contract, you should actually be entitled to 81% of the revenue and the margin, in which case you're carrying positive WIP here of 100. So then you've spent more than you've actually been able to invoice out, and then that's why you're feeling a cash pinch. So your profitability might be fine. As you can see here, there's no overs and unders. Profitability is okay, but you will be feeling cash hurt. And the way we sort of link this back together is it's going, well, if you're actually running a positive WIP business and your numbers are really predictable and you're actually profitable as just that cash hole, well, you can easily go to the bank and say, hey, here's my 12-month budget, here's my 12-month performance. We run a cash deficit, we're actually profitable. Bank, can you help me with an overdraft? And reporting like this, the bank will look at this and go, hey, your numbers are nice and predictable. I can see that you're carrying a WIP positive business. Look, we'll see what we can do to help you out. So that's how you start to use some of this information to create, meaningful, impactful conversations with stakeholders and banks and the like. Now, I'll come back up to this top project here. So I've given you a negative WIP example and I've given you a positive WIP example, because when you do aggregate all these together, it will spit down a number down the bottom here, which you should put into the accounting system. Now, the way that this works over here to the right is cost to date of 170,000. So costs that are not project costs. So ideally, you'll run a P&L, which will tell you this straight from 0 mile. But if you have some stuff that's unassigned, or your bookkeeping processes aren't great, or you know there's money spent in the back of your mind there, but it's not against a job, enter that number in here, because that's what we want to try and capture in this section.
Dan, sorry, just to jump in there, there was a question about that cost to date and whether that included the overruns and those additional columns you're talking about right now. It doesn't. I mean, it's just pulling, that's the number that you have in your accounting software right now in terms of your costs. And then these additional columns, M and N, additions to that, or subtractions, really.
Yeah, so it starts to chop it out really. So this is from the accounting software. This is stuff that might be missing. And then to that point, Phil, these are the overruns. Or you might have underruns, because keep in mind, you might be underrunning on the job. You might have heaps of fat in there, or contingencies you haven't used early in the project. So you can have a negative number in there, which will then drive up that revised gross profit. So if your accounting system is really good, you don't need this column. Just zero it out, delete it out. If you want to try and measure the overruns and underruns, there will be this column here. So hopefully Build Xact and Builder Trend will tell you that, whatever it happens to be. But in this instance here, this builder is overrunning on this job by $65,000, which is pretty damaging. So the builder was hoping to make 20%. Fast forward over to the right, we actually start to project what your new gross profit's looking like, which is abysmal. Like in a lot of instances, that doesn't cover overheads at all. So what we'd want to try and do here is lean on our good job costing processes, so we can start to see this number, and then we can start to talk about this number monthly, go, wow, we're doing this for free, because a lot of you guys should be running at overheads of around about sort of 10-ish to 8-ish%. It doesn't even cover overheads, and we want to know that number as we go. And this number here will fluctuate month to month, but definitely get it in. So if you have good job costing, this number falls out. If you don't, it becomes really, really hard to measure along the way. So pushing across to the right, and this is getting into the bit of the advanced territory, the projected cost complete is now different to what the budgeted cost is. So you might have noticed here that the quote was supposed to be 410,000, but this here has now gone up as far as the percentage completion goes, or sorry, as far as the cost completion goes, because we're saying that the original cost was this, and we're overrunning on this job by 65,000. So this can come up and down. So next month you might actually have a few savings in the business, in which case, well, you can bring that down to whatever number really, and this will reforecast out your GP. It will then also recalculate what your new gross profit's going to be, because guess what? If you're overrunning, well, that just comes straight off your profit. There's no way to sort of like gain additional variations or margin or anything like that. It just comes straight off the bottom line, which hurts, because you're planning to make 100,000 here, and it's landed at 45, which gives you a new gross profit calculation. Now, coming across to the right-hand side, all the calculation methods are the same. So this percentage completion actually picks up what you have spent to date, so the sum of these two, versus your new estimated cost of completion. So we no longer base it against the original estimate, because we're starting to see that we are overrunning currently. So the cost completion, where we have got known overruns, will actually sort of dilute the progress rate down, but it'll still do the same calculations to the right-hand side. So we're now saying that you're 47% of the way through the build. Invoice to date is 200,000. And it looks like here, for the completed work, that you should be entitled to 47% of the income, inclusive of these factors. So again, costs that were missing from zero, and we have the overrun, but you are still carrying positive WIP here over to the right-hand side. So just to refresh with this, is that this isn't a job profitability tool by job. This here lets you measure and get your numbers right in 0 mile, whatever it happens to be, and lets you see what you are running month to month as far as profit goes. So this here goes, well, what is the gap to my cash and accounts receivable? So this business here is carrying $99,000 in positive WIP, which means you'll be feeling a bit of a cash pinch because you're spending more than you're actually invoicing out. Whereas if it goes the other way, you're probably cash flow flush, but just be careful, because a fair chunk of that money is not yours. So I hope that sort of made a bit of sense. Essentially, it's quote in, what's the profit we're hoping to make? What are we spending? What's missing from our zero system? What are we over and under running here? Super, 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 super important. And then this will tell you are you running positive or negative WIP? Now, positive negative WIP isn't a good thing or bad thing. It just helps you unlock clarity in your business, smooth out that properly so you can see what's going on.
Question in there, Dan, about jobs that have a fairly large labour component, and how do we factor those in? Because, you know, they're going to be cogs. Are they entered as part of the cost date? That's the first part of that question. And then the second part is, what about project managers? Like, how do they sit PMs into? Are they part of cogs? Are they overheads? How do we handle those? And I guess on top of that, how do we get these labour components into our costing model? What's the mechanism for that?
Yeah, really, really good questions. I mean, I usually find builders are really good at managing, you know, materials and sub trades. It's always labor where people get stung on, to be honest, like 9 times out of 10. So the short answer is that we want to do a square peg, square hole situation. So however you're quoting, we want to line up the actual costs against it. So if you are doing, you know, God forbid, you know, you're doing square meterage rates for a build, you know, well, how do you know whether you're running it over or under for materials and labor, all the rest of it? What I want to see is, you know, we have this carpentry gang of, you know, 1 chippy and 2 apprentices, whether the mix is however many weeks measured in there by the individual stage items. Because if you can micro measure it, you can manage it. It's the way it works. So, I mean, the simple question to that is that, for example, if you're using Build Xact, ideally you'll be pushing work orders in. So if you're using something like Deputy, so that's the time and attendance system, you're capturing that data in, it goes against Build Xact, you'll run Xero in a parallel payroll process, push that out, but the payroll that's sitting in Xero should match Build Xact, as an example. Buildertrend offers a similar function, actually has its own time and attendance system, but you should be capturing...
Dan, sorry, just jump in there. Our bookkeeping team reckon Xero Me is a really good option for timesheeting. I mean, ultimately, you've got to have timesheets in play. And you've got to be allocating that time to jobs and making sure that it's being allocated, you know, to the correct job number, and therefore you're going to be able to pick it up as a cog, as a direct cost to the job. So, and then it will be picked up in your accounting system as part of the costs to date.
Yeah, correct. So, I mean, again, anything sitting up in cogs, I want to trace it back to a job, because that's how you sort of measure how you're performing, are you profitable, are you not. So commonly the process is called work orders. So similar purchase orders, work orders for labor. Otherwise, you can just do journal entries in Xero if you're not using a job costing system. But, you know, if I've worked, you know, 50 hours on a job and I'm on the tools on the hammer, I want to see where those 50 hours are gone. So you can do it via journal. Yeah, probably the best process is, you know, there's a poll at the end. Probably reach out. We can do a bit of a one-on-one chat. I'm happy to talk you through it, but I want to see labor against those jobs. Otherwise, you can't measure it, you can't manage it. Project managers, a really good question. It depends on how you run your business. So obviously, roving supervisors should be accounted for on your jobs. If you're doing larger projects, sort of $1 million plus, or you know, commercial projects as well, commercial managers or project managers will be factored into the cost of the build. So above the line, I guess. So you might have one project manager, but he or she might be running 2 jobs, in which case grab their wage divided by 2. Make sure you pick up superannuation and work cover on this as well. So similar to the labor component before, it isn't just the gross wage or the net wage, but make sure you pick up the on costs too, because superannuation and annual leave and public holidays and all the rest of it are really expensive for businesses. Also make sure you're not undercooking that. So project managers, look, it's sort of 50-50. Commonly, they will be part of the estimate or the quote. So it should be inclusive in the cost of the project. And so it should be inclusive in the margin of the project as well, if they are proper project managers. CAs and stuff like that, some of them are included, some aren't. It just depends how you run your business, essentially.
The question too, there's one that's come to us in the background around Xero Me's capability of separating labour into correct cost codes. Yeah, you got 2 levels within Xero Me of cost allocation. There's a job level, so you can allocate it to a job number, which if you're syncing it up with your software, like a Build Xact or something like that, you need to do that so that those platforms can talk. And then the next level is an activity level. And, these are just blank functions and fields in Xero. So you can use them how you want, but we've seen that next layer used as an activity code for things like, carpentry, framing, those kind of almost stage related tracking functions. But yeah, yes, you can separate labor within Xero Me. You can do timesheets. If you're an owner, you might even want to split your time. You might have some of your time going to an overhead, and then allocating some of your time, if you're still swinging the hammer, if you're still getting out and making sure jobs are on track and you're on site and you want to allocate some of your labor costs to the job, you can do that as well, and recommend that you do that. I think really all of this is about just trying to make sure you've got a good system for tracking what's happening financially with these jobs, and then sticking to it. Yeah, Dan?
Yeah, 100%. I mean, as Phil mentioned before, you can't be half pregnant with this sort of stuff. Either you're doing it or you're not. And because builder margins are so skinny compared to other industries, 1,000 here, 10,000 there really adds up and can create a bit of damage quickly. But the other side of this too is that if you're having lots of wins on the scoreboard, so you're having lots of savings, lots of underruns, or guess what, your profit's growing and your wealth's growing. I mean, I don't know about you guys, but I want to measure that sort of day to day, week to week, month to month, at a minimum monthly and go, yep, we're actually outperforming ourselves. Well done, guys. Here's some reward, whatever it happens to be. So WIP is the output of several good processes upstream working well and working efficiently. It's a bit of a capture all, and it's almost like a bit of a reward to go, are we okay? Yes or no? If no, what do we do?
So, Dan, I think we might push through. We're just about done here. So we might just do your final wrap, and then we can take some questions as well as we go through this last section.
Yeah, fantastic. So the wrap items are don't fly blind. Usually whenever I sort of catch up with potential clients or do other talks, I'm like, there's two things that you take away from this that you're not doing. One is job costing and all the disciplines that come with that. And then the outcome of good job costing and knowing your numbers is you have good WIP and you have better financial clarity. So definitely try and keep on top of that, please. Monthly is the gold standard. Strongly encourage you to do it. Understand what your WIP is. So don't just calculate the number, but it's the why. What is it? Is it good? Is it bad? Is it positive? Is it negative? Make sure you get really clear on those definitions, because it spits you out a number. Well, the number's useless on its own. It's best that you understand what the number is and what it means. How I got a cash flow hole, I might be massively profitable, but I have huge negative WIP or huge positive WIP. And then what does that mean for cash? Do I need to talk to a bank? Do I need to get an overdraft? Whatever it happens to be. And the final piece is, if you have WIP in there, you're profitable and okay, well, you can change your decision-making framework. Hey, I've got the confidence to chase that job, or hey, I might need to take a small haircut to tuck in this highly prestigious job in here, but I know I'm profitable, but I know it's going to be good for my brand and awards and all the rest of the master. Whatever it is, if you know your numbers, you have a better decision-making framework. So definitely plan for the future with that. The final piece, and probably one of the most important one, is who's currently doing your WIP. So I saw a lot of people tick, yes, we're having a crack at it. So who's doing it? Is it yourself? Is it a bit of a DIY piece? Definitely rewatch this video a couple of times, download our tool and give it a crack. The other piece is, well, you might be able to train your bookkeeper. So make sure that your bookkeeper is actually job costing in the process. So back in the day of getting invoices in quickly, get them in and get them paid quickly, that whole piece is dying and dead. Where we're sort of seeing more value out of the bookkeeping process is job costing. So knowing where you're sort of sitting unders and overs by line item, that is where bookkeeping is now. And it's your numbers, your money. I mean, a dollar comes in and a dollar comes out. Hopefully one's bigger than the other. It isn't the bookkeeper's responsibility. It's your responsibility as business owners. The other option here is that if you don't want to DIY or you don't want to train a bookkeeper, you might employ an in-house commercial accountant. So it isn't a tax accountant or, someone that's junior. So if you have some pretty serious turnover of 20, 30, 40 million, you probably need to find a pretty decent commercial accountant to get across your systems, your processes, your tech stack, all your inputs, so that you are getting some decent numbers in there. So if you're in that sort of $30 to $40 million space, 25-ish, you might be asking yourself the question, is now the right time? But hopefully you've got a good budget in place that tells you what profit you're making, what that cost of reinvestment is. Make sure you have that in the background. if you aren't quite at the stage to get a good commercial accountant, or you just don't know what one looks like or feels like, or the other option is to outsource it, or bring on a fractional service like us. So we break the back of it. We do this stuff all day, every day. We act as CFO for quite a few clients now. Just know when to sort of tap out yourselves. Hey, I'm spending hours on this 7 o'clock at night. I know I should be chasing sales. Well, outsource it. Either give it to us or someone else, wherever it happens to be. But there is a fractional service option there to give you guys a hand to break the back of this one too.
Righto. So Dan, this final poll here, I'm going to throw it up. So we've covered quite a bit of stuff today. We've been talking about we're happy to do a consultation for anyone that either wants help with a tech stack. So I've just popped that poll up there. We talked about being able to have a really good workflow with job costing and be able to make sure that all your systems are talking to each other properly. So we're happy to do a consult on that and just, I guess, provide a bit of guidance on how that might be able to work a bit better for you. So I'll leave that there just briefly. Also, we are going to wrap in a minute, but if there are any other questions, Dan, I did have a question here from Michael, actually Magdalena, who's talking about if you have negative WIP and not enough cash in the bank to match negative WIP figure, would that mean you're trading insolvently?
No, not necessarily. I mean, because the business is profitable, but the cash isn't working out. I mean, insolvent trading is you're not profitable and you have no cash, and you can't get access to cash, and there's no way out. So there's quite a gap there. If you have negative WIP and you don't have enough cash in the bank, I mean, you might be running negative WIP, but your business isn't profitable. So you could have negative WIP, not very much as far as the way as profit goes, in which case, that's an issue. Because WIP doesn't tell you whether you're profitable or not. You might calculate the WIP and find you're losing money month to month. I don't know. It's a fair question to ask. I quite like negative WIP, which means you're leveraging the client's money, the bank's money more than your own money and debt, because whatever happens, if you're carrying large positive WIP, it means you're going to be cash flow poor and strapped, in which case you might need to lean on an OD or personal equity or an Amex card, whatever it is. I quite like negative WIP. But if you have negative WIP in there and you're still losing money, that's not good.
Yeah. I mean, there's distinction between your profit calculations and your cash calculations. They are separate. WIP being the bridge. Dan, so I've just put up. This is a complimentary consultation with Dan and his team. So we've got a team of CFOs. So if you would like to have them walk through WIP, how you're calculating it. Any of the other things that we've talked about, job costing, we can take a look at that for you as well. If you wanted to talk to Dan and his team about the services they offer, CFO advisory, you might not be ready for a commercial accountant in-house at 150, 200K a year. You might prefer to have that at a part-time or fractional basis. Then we're happy to have a chat about that as well. There was another question there about whether the Build Xact WIP calculator is good enough to use. I think that really primarily comes down to how you're using Build Xact. You've got to be driving that platform properly for things like the WIP functionality, for things like we worked with them on the advanced cost tracking dashboard that they've built into Build Xact. You need to be doing job costing and cost allocation properly in that platform to have those kind of numbers work. So probably with that one, I would recommend Michael pressing the yes button, and we can have a chat to you about that as a specific, just to check on how you're using Build Xact so that you can get the right outcome there. Rightio. Any other questions? I'm glad, Danielle, we inspired you. It's great to inspire people with things like a WIP webinar.
Yes.
On a Tuesday morning in winter. If there aren't any other questions, thanks for joining us. We really appreciate your time this morning. Keep your eyes peeled. We're going to try and run these as a monthly session. Please get in touch if there's something that you'd like us to cover, that you're scratching your head about, if there's a topic that you'd like us to unpack. But yeah, thank you very much for joining us. Thanks, Dan, for your wisdom as always. And yeah, we hope to see everyone down the track.
Happy whipping. Thanks, everyone.
Good one, guys. Thank you. See ya.